The 10-year hitting its lowest level since the summer. But our next guest says that rates will be higher across the curve in 2024. Joining us now is Mark Okada of Sycamore Tree Capital Partners. Welcome back. It's nice to see you.
Hey, Scott. Good to see you, too.
Let me first just get your reaction to what happened yesterday, because, look, it's been a surprising year. I think you've probably been as surprised as anybody that, you know, the economy is where it is and the stock market's done what it's done. And here we are just coming off an incredible move in yields, too.
Scott, that the business of managing money this year has been hard. It's been humbling. I guess being wrong about the recession, being wrong about the stock market, we're still up, mid-teens, which is nice, but it's not 20, it's not 40. So it's humbling. And wow, yesterday was amazing. Amazing.
Was it truly the pivot that some are suggesting it was? I just had a conversation with a strategist who described it as a game changer.
I kind of have a different view on yesterday as far as, what Powell did. I, for one, given what we're seeing in the economy and the slowdown, it's not necessarily the recession call that would cause rates to drop enormously. I kind of think he's talking his book a little bit. I mean, We've got a lot of bonds that need to get issued next year across the curve, 24% more than we have now. So bond issuance is going to be up big. And given the massive moves down hard in rates, I mean, that's great for the Fed. They can issue those bonds at better prices. But I got to believe that he's talking his book a little bit as I look through and think through what happened yesterday.
Well, I mean, you could forgive him if he, is feeling pretty confident about himself and what they've done, right? Even starting as late as he would admit and has admitted, I think, himself, they've done a pretty darn good job getting us to where we are now, don't you think?
Oh, absolutely. I mean, it's a little bit like, you've won the in-season tournament. Now you're partying in Vegas, but it's still a long season. Core is still not close to where they need to be. There's going to be some work to go from here. And given the strength of the consumer and given the massive reduction or easing of financial conditions that happened because of what he said yesterday, I think it makes his job a little bit harder to get to where he needs to be for inflation and the target. So, again, our contrarian view is that we think rates actually stay a bit higher, and we're fading a little bit of the pivot party.
See, I don't think he cares really the way that people suggest that he might about, rates have come down a lot over the last month, so that's eased financial conditions. The stock market's rallied a lot. That's eased financial conditions. I don't think he cares about that as much as we might think. And maybe he told us a little bit about that yesterday where, he suggested that the inflation was not caused by, sort of historical standards, not from over-raging demand or anything like that. It was caused from a lot of supply chain disruption. He only cares about inflation. If the economy's normalizing, which is the word that he used, then they'll be able to cut rates for the right reasons, and they're thinking about cutting rates already.
Well, that's 100% the message that he said yesterday, and whether markets follow that route for the next year is really going to be the question. I, for one, think that the mixture of how we got here with massive inflation was both. I think we had a pretty stimulated demand side based on fiscal stimulus that didn't need to happen, and then we had a supply shock that was historic in a lot of ways. And to his point yesterday about the supply side, a lot of that has been taken care of. I mean, you really don't see that in the numbers as far as the supply of goods and services. Labor has pretty strongly rebounded, and we're onshoring a lot of manufacturing. I mean, if you're going to build a battery plant or a chip plant, those are long-lived assets, and that supply is going to be around for a long time. So I guess from that standpoint, it makes sense that he can be a little less worried about a big jump in inflation from here. But on the other side, on this stimulus side, I think he's underplaying the potential fiscal stimulus that we're going to see in 24. Remember, it's an election year, and Biden's approval ratings are horrible. And I think that what they do on that stimulus side could affect inflation and make its job harder. So again, it's going to be an interesting year to see if this pivot that's priced in everywhere we look across risk assets happens. Now, that being said, am I feeling a little more bullish about taking some risk? Sure. I mean, do we see this economy tanking anytime soon in the credit markets? Spreads are certainly not telling you that's the case. Liquidity is not telling you that's the case. So I think it is time to be a little bit more aggressive with risk. But again, we're not talking about buying triple C's or anything like that. We still want to be in the higher quality part of the market.